Principles of finance, a la shmup. ROE, it's not a type of sushi. When financial managers think about the word returns, they're not thinking about, that blouse washed me out, so I'm taking it back to Macy's for a different color. Rather, they're thinking about financial returns of the flavor, well, we put $1 in today and we expect a lot more than $1 back in a few years. That's financial return. And there are really two primary measures managers rely on: return on assets, ROA, or return on equity, ROE. All right, well, the broader concept just asks, am I investing well? Well, ROA measures the financial return investors received over the course of a year, generally, and is calculated as return divided by total assets. So what kind of return goes in the numerator here? Well, it could be net income. The only problem here is that net income sometimes has one-time charges, i.e. a lawsuit that was settled and, we lost. Or it could have big losses this year, which won't happen again next year. So we back them out. Well, maybe we call this recurring returns, so we can subtract out the one-timers. Yeah, that works. All right, well, what about taxes and interest costs in a volatile interest rate world? What do we do about those? And what about one-time gains on a sale of a subsidiary which carried a lot of debt and tax losses with it? Translation? Yeah, it's all very complicated. Well, most managers get past all that noise by ignoring net income and instead reporting operating earnings. So check this out. All right, revenues, cups, liquid, rent, labor, and 5625. Yeah, there we go. In this little model, it's the $7,500 figure. And we scan our balance sheet for you here at no extra charge from Shmup. Current assets and pounds of sugar. All right, so we have $118,000 in total assets. Very interesting in that these are the numbers 3 days before the Super Bowl transaction, and they're not pretty, right? From $118,000 in total assets, we've only been able to take out $7,500 in operating profits. You could have invested that money in a lot of places and done way better than the 6%-ish returns that it implies. But if you wait a few days and the transaction happens, depending on the deal structure, well, all of a sudden you have something more like $50,000 in operating profits with about the same total assets. So all of a sudden your ratios look a whole lot better. Moral of the story, sales matter. Having tons of accounts receivable are nice, but they aren't sales. Sales convert inventory to cash, and that, generally speaking, is a good thing. So if you had operating profits of $50,000 and total assets of $100,000, then your ROA would be 50%. Think about it in the form that if you had invested $100,000 this year to just buy those assets and you already got half your money back, well, you'd be doing exceedingly well. Big number, you're swinging. ROE is a different measure of how well managers are doing in returning earnings to shareholders. ROE uses fully taxed earnings or net income after everything, debt included, and it puts it in the numerator. Why use fully taxed and include interest costs? Well, because in this case, ROE is, quote, wedded, unquote, to the common equity of the firm, or rather the equity value of the firm. A big part of the equity value as far as earnings goes includes basically everything. Well, as the common owner, you are the backstop, the last word, the final say, so you have to pay for everything. So everything should be included in this calculation. Hopefully, not surprising then, the common equity or shareholders' common stock equity is the denominator. In our little balance sheet above, that would be the $98,000 figure right there. If our net income was $9,800 in a given year, then applying fancy pants math, we'd have ROE as 10%, right? And oh, by the way, in any of these calculations where you take a year's income in whatever form, operating, net income, EBITDA, you put it over the beginning of the year balance sheet item. Why? Because at the beginning of the year, you have your finite universe of assets with which to manage. Based on those resources, you then generate returns for the subsequent following year. So the denominator is kind of easy. Shareholders' common stock equity at the beginning of the year. That's it. So next time you hear about ROE, don't think about that sushi. Think about the Benjamins you pay to eat it.